stop me if you've heard this one before. A president wants lower interest rates.
Okay.
A Federal Reserve nominee has a long, very documented history of loving hard money and tight policies.
Right.
And yet, they just teamed up.
It sounds like the setup to a really, really bad economics joke.
It does, doesn't it?
Yeah.
But it's actually the reality we all woke up to this morning.
Mm.
It is Sunday, February 1st, 2026, and the financial world is, well, it's officially buzzing. Kevin Warsh has been nominated to be the next chair of the Federal Reserve.
It is the only thing anyone is talking about on the terminal today, and frankly, the reaction is just chaotic.
Chaotic how?
Well, usually when a Fed chair gets picked, the market instantly knows the vibe. You know, okay, this guy's a dove, buy stocks.
Right.
Or she's a hawk, brace for impact. With Warsh, you've got half the market shouting he's a hawk who's going to crush inflation, and the other half convinced he's some kind of dove who's about to slash rates.
That feels contradictory. I mean, you can't be both, right? You can't be the guy slamming on the brakes and the guy hitting the gas at the same time.
Well, that is exactly why we need to dig into this. There's new research from Compasscope.
Oh.
They just dropped a report, Kevin Warsh nomination, what it means for markets. And it argues that those old labels, hawk and dove, they're basically useless for understanding what's about to happen.
So if he's not a hawk or a dove, what is he? A platypus?
Close. Compasscope calls him an opportunistic hawk.
An opportunistic hawk.
And understanding that specific label is, I think, the key to figuring out your portfolio for the rest of this year.
Okay, I like the sound of that, even if I don't totally get what it means yet. But before we get into the complex strategy stuff, and I know we're going to talk balance sheets and yield curves, we have to figure out who this guy actually is, because I tried to look at his timeline this morning, and I got whiplash.
The whiplash is understandable. His career is, well, it's a zigzag.
Right. I mean, let's go back to 2006. He was a Fed governor then. What was his reputation?
Back then, and especially after the great financial crisis, Warsh was the guy constantly worrying about the punch bowl. A clear hawk.
The eat your vegetables guy.
Exactly. He was warning everyone that all the rescue programs, the quantitative easing QE, was just incredibly dangerous.
He thought printing money would just lead to massive inflation down the road.
Exactly. And moral hazard. You know, if you bail everyone out, they'll just take bigger risks next time. So, score 1 for Team Hawk.
Okay, so that's the baseline. But then I see this op-ed from 2018, the Wall Street Journal. The economy was doing pretty well. Unemployment was low. That's usually when a hawk screams for higher rates.
But
what did he do?
He completely flipped the script. The headline was something like, Fed tightening, not now. He argued the Fed should pause rate hikes.
Which is a total dove move.
It was. But then, fast forward again, 2024, Jerome Powell starts cutting rates, and Warsh comes out swinging, saying they're cutting too soon, that they're going to reinflate trouble.
So he's a hawk, then a dove, then a hawk. And now, I'm reading that since last November, he's back to wanting cuts.
Correct. And this is probably the most fascinating part of the Compasscope report. His sudden pivot to being a dove again. It isn't because he's gone soft on inflation.
Then why?
It's because of robots.
Okay, you have to unpack that. How does ChatGPT or the AI boom justify cutting interest rates? Usually, a booming tech sector makes the economy run hotter, which means you need higher rates.
That's the traditional view, for sure. But Warsh is looking at the supply side. He believes we are in the middle of a massive productivity shock driven by AI.
Productivity shock. Translate that for me.
Okay, think about it this way. If a company can suddenly produce 20% more widgets or, write 20% more code without hiring more people, what happens to the price of those goods?
I guess if it's cheaper to make them, the price should go down, or at least it shouldn't go up.
Exactly. That is structural disinflation. Warsh's argument is that AI makes the economy so efficient that we can grow really, really fast without causing inflation.
So he thinks the old speed limit on the economy is just gone.
Right. He thinks if the Fed keeps rates high, they're fighting a ghost. He believes they actually need to cut rates to let the economy expand into this new AI capacity. If they don't, they're just choking off growth for absolutely no reason.
So don't punish the economy for growing if the robots are doing all the work.
That's the bumper sticker.
Okay, that explains the opportunistic part of opportunistic hawk. He's a hard money guy at his core, but he'll cut rates if he sees a unique opportunity like AI.
Precisely. He's pragmatic, not dogmatic.
But there's another layer here. The politics. We can't ignore that President Trump is in the White House, and he has been very, very loud about wanting lower rates. Why would Trump pick Warsh? If Warsh has this history of being a hawk, isn't that a huge risk for a president who wants cheap money?
It seems like a gamble, but Compascope describes this as a very calculated two-step play by the White House. It's actually quite a strategic needle thread.
Okay, break down the two steps for me.
Step one is satisfying the immediate need. The president wants relief now. And Warsh has privately signaled, and this was in the Reuters reporting just a few days ago, that he is open to immediate front-loaded rate cuts.
Front-loaded meaning big cuts right away.
Yes. Getting the rate down to 2% or, potentially even lower very quickly, that gives the administration the economic juice they want.
So, here are your cuts, Mr. President. That's step one. What's step two?
Step two is all about the bond market vigilantes.
The vigilantes sounds like a bad Hades movie.
It's a very scary reality for a central banker. If the bond market thinks the Fed chair is just a political puppet who's going to let inflation run wild, investors will panic.
And they sell bonds.
They dump bonds, and long-term interest rates spike, which crashes the entire economy.
So Trump needs someone who looks like a grown-up to keep the bond market happy.
Exactly. Warsh has those hawkish credentials from '06 and '24. By picking him, the White House is telling investors, look, we picked a guy who hates inflation. You can trust him.
It's cover. He gets the cuts he wants, but with a badge of credibility attached.
And there's a practical element, too. Confirmability. Remember, Warsh has been confirmed by the Senate before.
Right. The research mentioned something about Senator Tillis.
Yeah. The politics are messy. Senator Tillis has been holding out, protesting the investigation into Powell. There was a real risk that a less qualified nominee would get blocked. Warsh is just safe enough to get confirmed, maybe even with some Democratic votes.
Okay, so we have the man, the opportunistic hawk, and the mission, the two-step play. Now we have to talk about the mechanics, because the Compascope report has a section on the policy mix that made my head spin a little bit.
This is the secret sauce.
They call it front-loaded cuts combined with aggressive QT. Now, to the average person, cuts and tightening, they sound like total opposites. Why would you do both?
You have to think of the Fed as driving a car with two different pedals.
Okay, I'm in the driver's seat.
The first pedal is the policy rate, the interest rate. That's the accelerator. When you cut rates, you're stepping on the gas.
Makes credit cheaper.
Right. Car loans, credit cards, it signals go to the economy. And Warsh wants to stomp on this pedal.
Okay, vroom, vroom. What's the other pedal?
The other pedal is the balance sheet, or quantitative tightening, QT. This is the brake. The Fed owns trillions of dollars in bonds. When they let those bonds expire without buying new ones, they are effectively draining cash out of the banking system.
So Warsh wants to hit the gas with interest rates, but tap the brakes with the balance sheet.
Exactly. He wants to cut the headline rates because that helps housing, autos, and voters. But he wants to aggressively shrink the size of the Fed by draining the money supply in the background.
That seems like a really delicate balance. Is there like a conversion rate? How much braking equals how much gas?
The Fed actually has models for this. Roughly speaking, shrinking the balance sheet by about $1 trillion. It feels like raising interest rates by 25 to 30 basis points.
Oh, wow. So if he cuts rates by, say, 2%, but drains a few trillion from the balance sheet,
yeah,
the net effect isn't actually that loose.
Correct. It's a way to give the appearance of easy money while keeping the financial plumbing tight so inflation doesn't explode.
But this must do weird things to the markets, right? I saw the charts in the Compascope report about the yield curve. It's doing something called bull steepening.
It sounds like jargon, but it is absolutely critical to understand this.
Walk us through it.
Okay, so because Warsh is cutting the short-term rates, the 2-year Treasury yield drops like a stone. It was down to 3.54% this morning. It follows the Fed.
Okay, but the 10-year Treasury, the long-term bond, that's not dropping. It's staying high, around 4.24%. Why?
This is where that aggressive QT comes in, and this is where we have to talk about supply and demand.
Let's use an analogy.
Okay, imagine the bond market is a grocery store that sells avocados.
I love avocados. Go on.
If the Fed is doing aggressive QT, it means they're stepping away from the market. They aren't buying. In fact, the government now has to sell massive amounts of debt to other people. So suddenly the store is flooded with avocados.
Too many avocados.
Right. And when there's a glut of supply, what happens to the price?
It crashes.
Exactly. And in the bond market, when the price of a bond crashes, its yield, the interest rate it pays, goes up.
Because they have to bribe you to buy them.
Exactly. To convince investors to soak up all that extra supply of long-term bonds, the government has to offer a term premium, a higher yield.
So the 2-year rate crashes because the Fed controls it. The 10-year rate stays high because the market is flooded with supply from QT.
You got it. The curve steepens. The
Okay.
gap between the short rate and the long rate gets really wide.
Usually when the curve gets that steep, isn't that a sign that people are panicking about inflation?
Usually, yes. But Compasscope argues that this time is different. They say the 10-year yield isn't high because of inflation fear. It's high because of supply mechanics. It's a policy mix signal, not an inflation signal.
That is a crucial distinction. Okay, let's get practical. I'm listening to this. I'm an enthusiast. I manage my own portfolio. If this Warsh trade happens, steep curve,
No.
cuts, plus QT, what goes up and what goes down?
Let's start with the winners. The biggest winner in a steep curve environment is banks.
Why is that?
Because the core business model of a bank is, well, it's pretty boring. Borrow short, lend long.
Right.
They pay you peanuts on your savings account, which is tied to the short rate, and they charge you 6 or 7% on your mortgage, which is tied to the long rate.
And if that gap gets wider,
The profit margin just explodes. So financials are a major buy in this scenario.
yes,
Industrials and small caps.
break that down.
Industrials benefit because the cuts create a soft landing narrative. People start building things again. And small caps, well, small companies usually have floating rate debt.
Kind of like a credit card with a variable rate.
Exactly.
Yeah.
So the moment Warsh cuts the Fed funds rate, their interest payments drop immediately. It hits their bottom line instantly.
Okay, so banks, factories, and small business are happy. Who is miserable?
This is the tough news for the modern investor. The losers are likely big tech and growth stocks.
Wait, hold on. Tech stocks usually love rate cuts. Every time Powell even hints at a cut, the NASDAQ goes to the moon. Why is this different?
It's because of which rate matters to them. Tech stocks are valued based on cash flows way, way out in the future, 10, 20 years from now.
Right.
When Wall Street calculates what that future money is worth today, they discount it using the 10-year yield, not the short-term rate.
Uh-huh. And we just established that the 10-year yield is staying high because of the avocado flood.
Exactly. The discount rate stays high. That makes those future millions from tech companies look less valuable today. It's a huge headwind for valuations.
That is going to catch a lot of people off guard.
Oh,
Okay, what about real estate?
it's a mixed bag. Commercial real estate, office towers, malls is in a lot of trouble. They rely on the 10-year rate for their cap rates, and refinancing is going to remain expensive. Plus, QT means banks might be pretty stingy with lending.
But what about residential? The house I live in.
That's more nuanced. The 30-year fixed mortgage tracks the 10-year bond. So, bad news. Mortgage rates might not drop to 3% again. They might get stuck at 5 or 6%.
What?
But adjustable rate mortgages ARMs, they track the short-term rates. So we might see a shift where people stop taking 30-year fixed loans and start taking ARMs just to get the cheaper rate.
It feels a little like 2007 all over again, but okay.
History does rhyme. And quickly, for the gold bugs, Compasscope sees gold as a winner. What? Opportunity cost. Gold pays 0 interest. When savings accounts pay 5%, nobody wants gold. When savings accounts drop to 2% because of Warsh's cuts, gold starts to look a lot more attractive.
Got it. So buy banks and gold. Be careful with big tech and office buildings.
Broadly speaking, yes.
Now, we have to talk about the risks, because this two-step play sounds clever, using AI as an excuse to cut rates while draining the balance sheet. But it also sounds really, really complicated, like trying to land a 747 on an aircraft carrier.
That's a fair analogy. Compasscope highlights 3 big ways this could go wrong. The first is what they call the snapback. Remember, Warsh is an opportunistic hawk. The risk is that he cuts rates initially to satisfy the political pressure,
Uh-huh.
but then his old DNA kicks in.
He sees a little bit of inflation and just freaks out.
Exactly. He might stop cutting way sooner than the market expects. Investors might be pricing in a cut to 0, but Warsh could stop at 3% and say, "That's it, folks."
And the market would tank because it was betting on more.
Right. The second risk is the plumbing problem. This is about the repo market.
We hear repo market and our eyes just glaze over. Why should I care about repo?
You should care because it's the grease in the engine. Think of the repo market like a giant pawn shop for banks. Every night, banks need to swap cash and bonds just to settle their books.
Okay.
If Warsh is too aggressive with QT, if he drains too much cash out of the system, the pawn shop runs out of money.
And then what?
Then the banks can't settle their trades. Panic sets in. And when banks panic, they stop lending to everyone. We saw this in 2019. The stock market can have a heart attack in about 24 hours if the repo market breaks.
So if he drains the tub too fast, the pipes burst.
Exactly. And the Fed would have to do a humiliating U-turn and start printing money again just to fix it.
Not a good look.
Yeah.
And the third risk.
Politics. We mentioned Senator Tillis. If his blockade holds up, or if the confirmation hearings just turn into a circus, this could drag on past May.
Leaving Powell as a lame duck.
Right. And markets hate uncertainty. If we don't know who is driving the bus, volatility just goes through the roof.
So as we wrap this up, it really feels like we're entering a weird experiment. We have a chameleon nominee, a policy mix that presses the gas and the brakes at the same time, and a thesis based on robots saving the economy.
That sums it up pretty well. If I had to boil the entire Compass Scope report down to one single sentence, it would be this. Cuts for the headlines, tightening for the plumbing.
I love that. Cuts for the headlines, tightening for the plumbing.
And for you, the listener, the lesson is, don't just watch the interest rate. Everyone watches the interest rate. You need to watch the balance sheet. That is where the real story of financial tightness is actually going to be told.
You know, I have one final thought I want to throw at you. A what if.
Let's hear it.
We spent a lot of time on Warsh's AI thesis.
Mm-hmm.
The idea that he can cut rates because AI is going to make everything cheap and efficient.
Right. That's his big bet.
What if he's wrong?
Wrong how?
What if the AI productivity boom takes 10 years instead of 2? Or what if it doesn't lower prices, but just boosts corporate profits?
Then we have a massive problem on our hands.
Right, because he will have cut rates and stimulated demand, but the supply shock never actually arrived.
Which is the classic recipe for runaway inflation.
Exactly. And if that happens, the opportunistic hawk is going to have to make a choice. Does he let inflation run hot? Or does he slam on the brakes so hard he puts the entire economy through the windshield?
If his opportunity disappears, the hawk is the only thing left. And historically, when a hawk has to fix an inflation mistake, it is a very, very painful recession.
A cheerful thought to end on. But hey, that's why we do the deep dive. Thanks for unpacking this with us. It's a lot to digest, but at least we know what to watch for now.
My pleasure.
And remember, this is all analysis based on the Compass Scope research, not financial advice.
Right.
Do your own homework, watch those yield curves, and we'll see you on the next deep dive.
This content is produced by CompassScope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on CompassScope.com.